Welcome to TradeTheNBA.com. This is John. This report is for the 21st. Pretty benign day the other day. We just ended up pushing up against the ABM yellow. It wasn't enough to push through it. We could see that there was a bit of softening from a short interest. Did get a DOC spread from that standpoint, but the short-term buyers have been fading since their peak here at the start of this drive up, sort of losing some of its steam because you need those shorts to really drive things extra. Some of that could have been the early leaking of potential revisions that are going to happen with the unemployment numbers, anywhere between 600 and a million fake jobs or revisions, if you want to call it that. They're going to call it revisions, but how you can be off that far pretty much wipes out any alleged gains that existed for the entire year. And this is something we've been talking about for a while, how the numbers have just been baked and didn't make any sense. You could look at the unemployment data state by state, as we've talked about before, and it didn't match what the federal government was reporting. And now all of a sudden they're going to make this massive correction. Why they choose to do it now, it's an interesting one, unless they just got caught with their hand in the cookie jar. Who knows? But either way, it's further evidence, and it's something the Fed needed in order to justify their rate cut. So that could have been the impetus behind it, but it represents a much weaker economy that had been broadcasted for the last 6 months. And I think that's the desperation of really wanting that rate hike to take place, because given what they were reporting for numbers, it wasn't justifiable. Now you can say, oh, wow, there really were no jobs created. And in fact, the only ones that existed were people coming from outside the country into the U.S. So, yeah, they're always going to spin a narrative that suits where they want to go with things. But still is no real justification for that rate cut, other than the economy has really slowed far beyond what they've broadcasted, and that sort of goes against the whole narrative situation. From an NQ standpoint, again, hitting right up against the beginning of the algo and struggling right there. And it becomes critical here, because once you get to a positive shakeout, you start to fade off of that even slightly. You're going to end up with a much more significant pullback than some might be expecting. So bear that one in mind. And it wouldn't be a shock at this particular stage anyway. Particularly if the numbers are going to be super soft. There could be some excitement, though, that the Fed is going to ease. That is exactly what the bond market here is betting on, that rates are pretty much going back to nil. And they've been epically wrong, sort of and not, because at the end of the day, looking at the data, we've had some significant issues. Is it justified, where the bond market is versus where the reality is? Because inflation still is not tamed. They like to talk about the month-over-month rate increases, but that doesn't change the fact that from the broad standpoint, it's still been elevated. We've continuing to see the dip in oil. A lot of that is the easing of tensions. People don't believe that there's going to be an imminent attack, so the buy-off of the Iranians obviously worked to some degree, and hasn't been anything relatively new coming from the Russia front as far as attacks against Russia oil infrastructure. So that both of those elements calmed down enough that we're seeing the fear part of that trade-off, but now becomes a question of how much lack of demand is existing, and is that going to accelerate? And if so, then it's clear indications of recessionary move. And you can see the euro taking a massive ride here, continuing off of that cyan under red DOC. And progressing from there. So this puts them in a beautiful range. They're almost at the upside of the 112 to 108 range. That super comfortable. Not that the Eurozone is doing anything, but that's not really relative. It's just the expectation that the dollar is going to have lower rates, and therefore there won't be as much drain capital-wise wanting to go into U.S. equities. And of course, what Japan did, and that staved off any further collapse within euro and stopped the strengthening of the dollar. I don't think that Japan's going to try that one again, because the markets have told them, we're not going to let you get away with it unless you're ready to answer for the pain that we're going to cause. However, the real world, gold continuing to make new highs, and it's going to continue to do so because at the end of the day, everyone who pays attention to what real money costs and that knows that you've got to be in some other version of it simply because the fiats are having difficulty justifying their value given real assets because at this particular stage we don't know any central government of the West that is even remotely close to a normalized budgetary situation. From a Bitcoin standpoint, still struggling. And they've got to work through those issues with everything that's been going on with the settlements and that. But once that's evened out a little bit, I think that there will be a significant surprise to the upside, and it'll be random when it happens. At least it'll seem random, but from a supply standpoint, at least Bitcoin, you know where you're at. From an ETH standpoint, it's struggled a bit more, and still not exactly an ideal readings for move up, and you can see from that shakeout, there's just been a lot of spread of distribution. 50K chart, clean. The buys, a little bit of break. Same thing happened. Then we had a little bit of breakdown, but as you can see, just because you get the steel moving under the negative 13.5, that gave a small move, but once it moves back above, you know that you're going to continue the push back above, and not a whole lot has changed. That we don't quite yet have that DOC spread, but even if you do, you're still going to have steel coming from underneath. It's not going to present much of a decline mode from that standpoint. So you'd have to see a pretty significant DOC spread with steel also rising up through that would indicate that shorts are in a position of any kind of strength. But we're caught in our little narrow band here between these two algo levels that have existed for quite some time. Intraday, pre-market shoot up options, and they faded them all off, and then once they got enough people excited to get a little bit more in the protective state, they were able to drive it back up again. So you just flipping them back and forth. Nice little whipsaw for them. From a post-market standpoint, we're just coming back off those previous day highs right before the close, trailing off it a little bit, nothing too spectacular. So again, it's just that back and forth, which is relative mean reversion, so it's not all that difficult. And unless the market has a negative reaction to the job revision, which I doubt they will, you're likely to continue to trot around until they can find an impetus to drive things forward, and maybe after DNC final speeches or whatever, they'll go with another rally. We'll see how that plays out. But at the end of the day, we're getting ready for the final stages of the campaign, and that's going to make for an interesting trade. They've all seemingly deleveraged from their positions, and once they have a clear idea where they think things are going to go, then we'll start to see those trades activate again, and that'll be a whole other series of transition, which could be a little bit rocky, but we don't really worry about that because we'll see it as it happens and be able to follow it along clean. As always, though, anything relevant, I'll put on the Skype chat. Have a good one. Trade well.